Cloud. Hello, hello, and welcome to our webinar of Real Estate Investing for the Win. I am Linda Peterson, and your co-host is Andrew Brown, and we're excited that you have joined us for our next week of Real Estate Investing for the Win. And today we will be covering residential versus commercial, the big battle out, right? Do you like residential? Do you like commercial? Do you like both? Why? We're going to tell you our thoughts, our feelings, and make sure that you understand the foundational pieces of what is residential versus commercial, and how to invest in each. So in this session, we will explore the differences between residential and commercial real estate. We'll discuss the unique benefits and challenges of each and how to decide which investment aligns with your goals. This is a webinar series. We are going to be covering different topics as we go along, bringing in experts for each niche that really targets both newer investors as well as savvy investors. Each niche we find takes time to learn and do. And so maybe actively investing or operating in a niche, it takes longer than you can invest in different niches. So we will be bringing in other experts in different arenas than what we have, and then offer even opportunities to invest in with them as well. So let's go ahead and get started. Today, what we're going to cover is, and these buttons are out of order, that's okay.
Hey, Linda, before you get started, one thing I
Yeah.
wanted to call out. So
Yeah.
this is a webinar. We are doing it live. We'll do it live every Friday at noon. And
Yes.
we had people last week and we've got people this week joining and live, which is great because then you have the opportunity to ask questions and get them answered real time. The other option is to watch them after we send them out or send you the link afterwards. So we're good either way. We just want everyone to know they've got options.
Yeah, thank you for that. Yeah, we will be posting this webinar on YouTube, and we'll be sending out a newsletter. And I'll show you how to, just by registering for this webinar, you're automatically going to be added to our newsletter. If not, just reach out to us at the end of this webinar. We'll show you how. And then I'm also going to try to break down the videos because sometimes we don't have an hour to dedicate. We just want to hone in on one topic or rewatch just one topic. So thank you for that. So yeah, so residential, commercial defined, ways to invest in each, pros and cons of each, and of course, Andrew and I have varying opinions. Ironically, we've worked side by side for a dozen years in real estate, but yet we have very different opinions, and different. We always ironically attack things in opposite ways. Everything we do, like I never knew that there was another way to do it until he does it. So, and then of course, talking about not only our opinions, what might be right for you if you're looking to invest both actively or passively. So, getting started here, residential investment types. Just want to make sure that you think through this. And then Andrew, I want you to give some thoughts on some of these that we've done, and what other people have done that we've seen. So typically we define it as 1 to 4 family residential, which could include, single family. It could include duplex, triplex, quadplex, mobile homes, even tiny homes. And I think we would even argue that an RV can be kind of a tiny home. There's park model cabins, there's modular. Andrew, your thoughts on residential investment types and stuff we've done too?
Yeah, there's all sorts of different flavors. I know townhouses aren't on here because we happen to be in Central Texas, and there are townhouses here, but not as many as in other parts of the country. And it really doesn't matter. It's basically saying 1 to 4 families can live in the building, and we'll get into it a little bit why it's very different targeting 1 to 4 family residential versus an apartment complex where you've got 500 families. It's a very different animal.
Mm-hmm. Yeah. And so this is actually a picture of one of the properties that we did. I remember it was 2 lots. One was selling as a house, one was selling as a piece of land. And, at the end of the day, the people who wanted the land didn't want the house, and the people who wanted the house didn't want the land. And really the seller just needed to sell both at the same time, have time to move out. And we were actually, I don't know if you can see, there's actually 4 houses here. So we had to really learn the local code to figure out what we could build in that area. But yeah, I mean, we've done a lot of variations of this. And so I wanted to walk through if you're actively investing or passively investing in real estate and the different types. So if you're actively investing, the typical cost to invest, right? Your purchase price, construction costs, holding costs, selling costs. What's your time to invest? So time under contract, remodel, time on the market, time to sell. What's your return on your investment, right? What's your profit after all of your costs? Either money you put in or using other people's money. We love using other people's money, right? It creates a win-win. And then risks, right? What surprises, market volatility, dealing with contractors or jurisdictions. Andrew, any additional thoughts on when you're actively investing in real estate?
No, it's funny. You already mentioned that you and I come at things differently. I would have put passive first because passive is simpler. You just sit back and find someone else to do all this work for you. What you've done
Yeah,
is you've called out, here's all the stuff you have to do if you're actively investing. And this is the most important takeaway from all this, from anybody watching this, should be figure out who you are, figure out what
yeah,
you want to do, pick what's right for you. There's so many different ways to make money in real estate. It's finding the one that has an interest or fits your capabilities, your needs.
yeah. Beautiful. Thank you. All right. So then ways to actively invest. Obviously, and I'm just really simplifying it here so that we can have a discussion, wholesale, flip, or develop, right? And there's all these flavors to it. I know you're already thinking,
I'm just laughing because this is why some people decide to go passive. This is actually a very good picture of this house.
yeah,
This was a hoarder home. And when you take on a hoarder home, if you're an active investor, you've created a lot of work for yourself. So it's again figuring out what makes sense for you. But to Linda's point, so wholesaling is simply you find a house like the one in this picture. We found it, we bought it, and then what we could have done is change the sign in the front yard, marketed it a little differently, and probably made some money on it.
mm-hmm,
Nothing more. That's wholesaling. Flipping is you then decide, you know what? I'm going to clean out this hoarder house, maybe rearrange some things on the inside, redecorate it, replace the plumbing. I'm trying to think of what we did on this house. All the flooring, paint the outside. So a lot of things, flipping the house and make money that way. And then developing is, this house wasn't the case, but the previous one, the previous image was, where there was an existing house, which was a kit house bought from Sears and Roebuck's company. These people actually bought this house, all the materials, and built it themselves. At the end of the day, we had to tear it down and build new, and that's the development side.
yeah, no, absolutely. And you can even add additional flavors to that for like the flip, right? You've got cosmetic, you've got full gut, you've got full gut addition as well. And each jurisdiction has different requirements. So you need to make sure what you can be allowed to do by the local jurisdiction. Even converting garages, you need to make sure that you can do that before you just assume so and purchase it. And so there's a lot to do that you can do up front to make sure that you reduce your risk and are set up for success.
Yeah.
And then developing, like we've even moved a house, right? We bought the land, we moved a house, and then we remodeled it after the fact. And
Whose crazy idea was that?
that was mine because
Yeah.
putting things in the landfill hurts my soul. So
And
down here,
I jokingly say whose crazy idea that is. We sold one for quite a profit, and the second one turned out so well that our son is living in that house. It's
yeah,
beautiful. So it was a brilliant idea on her part. All I was going to say is when you look at this list, again, if you're trying to figure out who you are as an investor, if you're enjoying what you're doing, or if you want to try something different, to me, I look at a wholesale. Wholesale is done correctly, very low risk. It's kind of hectic, but it's very low risk. The reward is a little bit lower than what it can be for flipping a house or developing, but it's lower risk. So there's a balance there. Flipping a house, there are people, and my mother was this way. She loves doing interior design. She would have loved the picture, the house in this picture. She would have walked in once it was cleared out, and said, oh, no, 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 the kitchen needs to go here, this color countertops, let's do this in the bathroom, let's change those windows. And there's people who just completely enjoy flipping a house. Developing is a completely different animal. That's where you have a raw piece of land and say, what the heck should I do with it?
Yeah.
And for a lot of people, that's too nebulous. They can't even get their arms around it, and it hurts their brain to think about it. Some people it's their happy place. They see a vacant piece of land and all of a sudden the ideas start flowing about, wow, what could we do with this? And that's something we've gotten into, but that's us. So,
Well, and I would argue that
oh, you're
not
gonna argue
any
with me
one
already?
person
Wait a minute,
always,
we're 15
always.
minutes in and you're arguing with me. Okay, that didn't take
Yep.
long.
Yeah, well, I mean, the reality is that not one person has the skill set to do all of those pieces typically. And so, getting somebody to come on board with you that has, complementary skill sets is important. And ironically, right, like when we got married, 40, 50 years ago, right? We didn't know this about each other, right? We met in the corporate world and we didn't know anything about entrepreneurship, but ironically, we do have some overlaps, but we actually complement each other because I'm not good at designing. I'm actually not artistic, but I'm really good at the construction, the execution, the budget, the marketing. So I really love people and technology, and I'm good at that. And plus, I speak Spanish. Whereas Andrew, you're really good at negotiating and sales and design, right? Both not only from land, but also designing the house, seeing how to remodel a house, and then the finishing touches. Because I mean, I remember laughing one time when as you were picking out tubs, and I was like, okay, well, what's the difference? And you started going into design. And I was like, no, I don't care about design. Just tell me the cost difference so I can put it into my budget. And so that worked out well. So yeah, there's a lot of different flavors. And the what we've learned is the more you know how to slice and dice a deal, the more ways you can turn it into revenue and an opportunity. So, and as you said, wholesaling has less risk, right? Don't get into flipping or developing until you can handle that financial risk, right? So next up is passive, right? Ways to passively invest in real estate. And this was one of our properties that we did. I tried to include all of our own pictures so that we don't get in trouble. So passive, you can invest as a debt lender, right? First position, second position, right? Andrew, you want to talk about the different positions and what they mean?
Yeah, so simply put, if you're lending money on a house, and for those of us that have a house with a mortgage on it, your mortgage lender is in first position. If you then go and get a home equity line of credit, that is a loan against the house, but it goes in second position. So if you stop paying your bills, whoever's in first position, they can go after you and they get paid first. So first is the more secure position, but there are times when going in second position makes perfect sense. So for example, when someone does give you a home equity line, they will only give you, if anybody that's ever gone and gotten to get one, they will tell you how much they'll give you. And the way they do that is they look at your ability to pay. They look at what your house is worth. They look at what whoever's in first position has loaned you. And then they see what the difference is and say, oh, there you've got 300,000 in equity in here. We'll give you 100,000 or whatever the number is where in your area. And that's how they determine it. So it's not saying second position is bad, but there are, this is important to remember, a lot of lenders will not go in second position. So just something to keep in mind.
No, it's a really good point. Like when you're getting started, hard money is more the most expensive typically, but most of the time you don't have a private money lender who can lend all of it, and is willing to lend all of it on that one deal, especially if you're new. So hard money lenders, right? They'll typically lend um, on just the asset sometimes, not even your own credit. But what we found is that sometimes, remember, we even had one investor who was told never, ever, ever be in second position, never be in second positions because that risk is too high. And yet we were doing a piece of land where even in second position, the value of the land itself was more than the sum of first and second position. So it's always not only position, but comparing to the value as is in future.
Right.
Right. Yeah. And then how to protect yourself, right? So I just put a couple things in here. CMA BPO, comparative market analysis, and your broker's price opinion. So what are third parties stating is the value if you're investing, whether you're lending or investing, and then, you know, getting an appraisal as to potentially if you're fixing up, what's the future value. Working with experienced investors that are doing the work, and then securing your note with the collateral through a deed of trust, and then making sure you're added as an insured
Yeah, and
beneficiary.
Linda just threw the term deed of trust out there. And for those of you like me that aren't attorneys and don't play them on TV, you don't need to know what a deed of trust is exactly. I mean, you do, but you don't. The important thing here is actually having, she's got experienced investor, I would say an experienced real estate attorney, not just an attorney, a real estate attorney, someone who specializes in this. And you find one you like and you sit down with them and say, hey, I've got 100,000, 200,000 in a self-directed IRA or just in cash sitting in the bank doing nothing, or I'm pulling it out of the market because it's driving me crazy. And I want to lend to people who are either so I can purchase a home and flip it or lend to someone else to do it. How do I protect myself? And if you've got the right attorney, he'll be all over it. He'll say, yeah, you need this document, this document, this document. Here's the order for signing them. You have to pay me a fee, but I will get them all DocuSign for you. You just need to provide some information and you're protected.
Yeah. Yeah. And it secures you against the property. So it gives you the option to foreclose if needed. Right. And I always find it interesting comparing real estate to like stocks, because in the stock market, you're buying a share of a company that you have no control over. But what really is your collateral or security, right? You don't have insurance on a stock, where here you have insurance against the property. The value of the land never goes away. Well, with a stock can completely go away, right? So you've got, I think, more measures of control in real estate than you would even in the stock market.
Yeah, and you just hit on a great one when you mentioned insurance that a lot of people forget about. Think about, again, your personal home. If you have a mortgage, your mortgage lender requires you to have insurance, and then they are listed as additional insured on that insurance policy. You may not even remember you did that, but you did it because the bank will make sure you did it. In a case like this, where you're lending on a house for a flip, let's say, the right attorney will tell you you need to get their insurance documentation and you need to get documentation showing that you are listed as additional insured on it. And that's, again, that's where a experienced attorney it's worth it. You need to find one.
Yeah, remember the house that we did where they didn't secure, we had just installed the wood floors and they didn't secure the doors, and then we had a big storm. And ironically, we had a meetup out there, so we had pictures of proof of people standing on the flooring.
Yeah. To be clear, we had everybody out before the flooring was put in, and we had pictures. We had everybody out after the beautiful flooring was put in, and there were pictures. Yeah. And then we had everybody out after they came back and all the flooring had been yanked out. And everybody was like, what just happened? And yeah, the insured person tried to claim that the flooring, how do we prove the flooring was in? So we sent a picture of the flooring in. It was, that was a beautiful moment. But we were listed as additional insured. We didn't have to rely on the person who was insured. You know, a lot of people won't want to file with insurance. It's kind of like when you get a fender bender. You know, can we just handle this outside of the insurance companies because we don't want it to go on our record? You got to protect yourself. You need that taken care of the right way.
Well, and ironically, all the people attending our meetups in that picture were eyewitnesses.
Yeah. That was fantastic.
All right. So purchasing a rental, for example, if you want to invest passively in residential real estate, you can buy a turnkey rental. And I think in the future, I'm going to be having, because Austin market is it's hard to have rentals that really cash flow, because we've typically been appreciating compared to the rest of the nation. Our price points for residential are higher. I will be having somebody on one of our future webinars who does turnkey in a state and in a location where the price points are lower, and they fix them up, they rehab them, and have turnkey rentals, so you can get in at a lower price point and something that's already fixed up. So
and just to clarify the term, because some people may not know that term, turnkey rental. There's one thing of finding a house and lightly fixing it up and turning it into a rental. What Linda's speaking about is there are companies out there, all they do is find rentals in great markets. They handle everything. They handle finding it, making sure it's in a good market. They handle every piece of it, and they literally fixing it up, and then they hand you a rental in great shape. And they can even handle the property management of it.
Yeah.
So that's what a turnkey rental company. And then what she just spoke to is there may be people listening who are in markets where maybe a rental isn't a good idea. In our particular market, the average home price is $560,000. And if you can only rent something for 2,500, the numbers may not work out. Whereas if you go to a market where you can purchase a house for 200,000 and rent it for 17 or 1,800, makes more sense to buy it there, and you can buy more of them for the same amount of money.
Well, and that was my challenge when we first started doing real estate. I was like, I just want to do passive, and then I want rentals, and then, you know, realized that our market wasn't the best for that. So we had to do a different avenue. So, okay. And then, you know, purchasing a rental, you can manage it yourself or with property management. Really, truly passive would be utilizing a property management. But we see several people who are, you know, they invest in it themselves. They save up their money. They put down the down. They use a traditional bank, but then they manage it themselves. So it's still kind of a hybrid of I'm passively, you know, renting it, but then I'm actively managing it. So you can passively invest and then passively manage too. But then there's a hybrid, right? So we talked about active and passive, but then there's a hybrid where you're active and passive, right? And that's kind of confusing. But one example I have here is the BRRRR, right? The BRRRR, right? BRRRR, which is you buy it, you rehab it, you rent it, then you refi it, and then you repeat it.
Yep.
So, and that can be, you take a flip and you convert it from a hard money and private money to a 30-year note, traditional lender. And you can manage it yourself, or again, property manage it. And you can even go as crazy as buying the land, moving a house, fixing it up, and then renting it, or developing a house, keeping it and renting it.
Yeah, Linda threw an extra R in for that one, for relocate the house.
Relocate.
And here's why this is important, and this is kind of the purpose of this webinar, is to share. Here's all the different flavors, and I'll give you a specific example why this makes sense. I mentioned the house where my wife had that crazy idea to move a house across town, which we watched, and it's interesting. That house, our plan was to flip that house. That was our plan. And while we were fixing it up and getting ready to put it on the market changed. And that happens. It's the economy cyclical, retail cyclical. And if you know all these different tools and different options, you look at it and you don't think, oh, what are we going to do now? We're going to lose money. We're going to have to sell it at a loss. No, we turned it. That was the house we turned into a rental. And as we were looking to rent it out, our son's like, this house is beautiful. Can I live here? So we're renting it to him. But the point is, we're literally, we switched from flip. Well, we relocate to flip to a BRRRR. And it's nice to know all these different strategies.
Yeah. And then you can keep it while it's appreciating, right? And they're paying down the principal. And then you can depreciate, right? So there's so many variables to it. You got to figure out what your market is, or what the market is that you're trying to do versus your goals. So just at a high level, Andrew, just open thought, right? Pros and cons of just residential.
So here, you guys are going to learn this about us as you watch more of these. I immediately go to the cons. Linda immediately goes to the pros. Here are the cons. Since you asked, you made the mistake. You asked.
Hey, I'll wrap it up with a beautiful bow. It's okay.
There you go. You'll do the pros, and then everybody will leave with a good flavor. Yeah, the cons are residential can be it can be a challenge, and here's why. If you're in a market where people decide they want to get into real estate, they don't immediately jump into, I want to do a big commercial complex. I want to do a big apartment building. I want to do a retail shopping center. Generally, the entry point for most people into real estate is flipping a house, residential real estate. So here's what this means. You're watching this webinar, you're getting education elsewhere, probably. Whatever you're doing to learn, if you're watching this, it shows you're trying to learn. You're competing against people who aren't necessarily doing that. Some of them are a little bit lazy, or they just don't know, a little naive. And let's say you find a property and you want to rehab it. You've done all your due diligence, you've looked at it and said, it's got this, and this wrong with it, but I can fix it up for this, and this. The person's problem is that they need to sell it quickly. I can solve that for them. You've got it all solved, and you know that the most you can pay them is $201,764. And at some point, we'll explain why I said that number. But you figured out that that amount is the 201,764 is the most you can pay for it and make money. And you present that to them. And somebody else who doesn't have the knowledge you do, who didn't do an inspection, who didn't realize what type of plumbing was under the house and that it was all going to need to be replaced, or that there was a foundation issue, or there was a zoning issue. They didn't do that homework. They look at it and say, hey, I can offer you 300,000 for this. Well, if you're selling the home, that person's going to take the other offer and not yours. So one of the challenges with residential is it can get very crowded as far as trying to find the properties. It's very competitive. So I would say that's one of the bigger cons we've run into. Linda,
Yeah.
do you want to hit us with some pros so it's not all
Yes.
negative Andrew?
Yeah. So real estate investing is something that's tangible, right? And you can create money, and you can replace your 9 to 5 job, and you can also create wealth at it. It is a lower price entry point than commercial, right? If you were born without a silver spoon in your mouth like we were, right? If you weren't raised on and knowing how to invest in real estate education, right? You can start with wholesaling with very little investment, and you can turn it with fairly low risk and get a return that can really start to take that skill and increase it. You can make good money in real estate. Of course, the more reward, the more risk, right? So that's one of I think a big pro for residential is that you can invest at a lower price point. You can get a good return. You can replace your 9 to 5. And then you can a lot of people love taking the model of, let me do active, get a flip, get a return on a flip. And then every few use that money, that profit to go buy a passive, and you can create that process. Whereas when you're typically in a 9 to 5 type job, you have one employer, one source of income, right? And so this can be diversifying with real estate, diversifying your portfolio, and having, each house can be a separate stream of income, whereas your job is just one.
Yeah, I'm not trying to take over and usurp Linda's pros.
Yeah,
But I
you
will
could have
throw,
better pros than mine. I don't care.
I'll throw
I'm
another
all
one
about the
out there.
positivity.
Yeah, I'll throw another one out there. So Linda joked about, actually, she wasn't joking, about me doing the design work, and it's just not her thing. At the same time, most of us have lived, I don't think any of us, maybe there's someone on here who grew up living off the land in a tent, but most of us have lived in a house at some point, or an apartment, or something. And look at the picture that's on the screen right now. It's a kitchen. And it's hard to see from this photo, but if you look at the range, when it opens, you can't tell from this picture, but trust me, the space in between the range and the island is in the 4 to 5 feet range. And we made enough space because you have to have room to walk past. You can't block that with an oven. And there are reasons the oven needed to be there, and it made sense, but we made sure there was enough space. Linda may not be into design, but she is certainly intelligent enough to walk in, look at the design and say, hey, you know what? This isn't going to work. And that's where the benefit of residential is everybody has some experience with residential. There's some level of comfort. Now, if you talk about building a shopping center, okay, we've all been in shopping centers and maybe some of us have worked in them, but it's a very different animal.
Yeah.
So I see, I threw a pro in as a bonus.
Yeah, and the reason why I'm laughing is because every time we go to design a house, we're like, okay, well, what is it in our house? And we go like walk off the living room, or measure the island to the counter, or measure the doors into the bathroom.
Right.
And then like the shelving in our closets, how long are they? We literally use our house a lot to say, okay, this is what works in our house. We need to make sure that you can do that in residential. So I 100% agree with you.
Thanks.
Okay, so commercial, right? Commercial investing. Commercial properties are typically defined in one of the following categories: multifamily, RV parks, office buildings, retail spaces, warehouses. Any that I missed? Because I know of one.
Yeah,
I
I would
missed.
say rather than put RV parks, it's probably modular, which includes everything from mobile homes to container homes to RVs, tiny homes. They all fit under modular. Modular is simply it's built somewhere. It's not built on site. It's built in a warehouse or in a factory somewhere.
Yep. Another one that I thought of was self-storage.
Yeah.
And I haven't even gotten into industrial or agricultural, right? I'm just focusing on commercial investments that handle people more so.
I mean, commercial could be almost anything. I remember in our area when they were building a water park, that was a group of investors that decided we're going to build a water park.
Yeah. Yeah. And you can take it and combine them, right? So you can have multifamily like apartments and then retail in front, or, retail below, and then office, residential units above.
Yeah.
So you can do a combination of them as well. So actively investing in commercial, right? Andrew and I had a debate on how to simplify this, but to me, it was just operator versus sponsor, right? And, we'll talk about kind of the nuances between the two, but really operator, we'll see if he comes up with any that I didn't think of to put on the slide. Operator, so finding the property, negotiating the purchase, managing the feasibility, entitlements, permitting, development and/or construction, and managing the operations, marketing, and financials. Inversely, sponsor is someone who creates the financials and investor presentations. They're the ones that secure the lenders, set up the syndication, market, and bring in investors, and then manage raising additional capital as needed.
Good job.
Anything you want to add in here on being an operator?
No, I would say the difference to me is the operator is getting their hands dirty. That's really it. Not that it's funny because people will say money is dirty and the sponsor is more on the monetary side. But I would say the operator is for someone who really wants to get their hands into it.
Yeah. And the sponsor is really capital raising, right? Raising capital, whether finding debt, finding investors for equity, right?
Yeah. Now, the interesting part is there's an overlap here. That whichever side you're on, you need to have a thorough understanding of the project.
Yeah.
If you're trying to raise funds and you don't understand the project, why it will work, why it's better than another project, why maybe it's not a good idea, so that you want to walk away and not have people invest in it, you need to thoroughly understand it. As the operator, kind of the same thing. You need to figure out what, we've found pieces of land that we've looked at it and said, we need to walk away from this one. We've looked at it from seven different angles and it's not going to work. And then we have others that, and that's why I keep the picture behind me. That's a piece of land we're buying right now that it's going to be glorious. And we've got several different ways it will work. And we understand that and we're able to communicate it both from an operator side and a sponsor side.
Yeah. And then I would say that the operator is somebody who maybe knows more about construction, has that vision, and can manage once it's launched and operating as a business. But you don't have to have that same person be all of it, right? You can have people who are specialized in finding land, people who are specialized in entitlements and permitting, and then somebody who specializes in construction, somebody who specializes in the operations and marketing. And then some of that you can outsource to property management and GCs, right? And you can have somebody who's the operator and the sponsor, right? Which is kind of where you and I are at right now, which is we're operating and raising the capital ourselves. But to be a sponsor really means that you have a big network, right? And you're really good at marketing as well, right? Reaching a lot of people.
And it's really,
Uh,
again, we keep going back to this, or I keep going back at this, so I'm sorry if I'm harping on it, but it's really figuring out, one, what do you want to do? How do you want to be involved? What's your strength? What's your weakness? What maybe should you stay away from? And I'll give you a really good shiny example on this one. Think about Apple computers. Steve Jobs was visionary. I don't think anybody doubts whatever you think about him. He was visionary. And then he would take that vision and hand it over to someone else in operation, say, here, go get this done. Because that was not him. He tried it. It wasn't for him.
right.
So it's really figuring out what's your niche, what's your strength, what do you want to be doing, where are you happy?
Yep. Beautiful. And then ways to actively invest, wholesale, flip, develop. So very similar to residential, but then I added manage, right? Because typically and I guess I could add it to residential, right? So wholesale, I would argue that commercial properties are actually wholesale more than even residential, right? And sometimes you've got somebody wholesaling to a wholesaler to the end state because it's where people see opportunity that others don't.
Yeah, and
Um,
let me, and I hope I'm not jumping ahead too much, but there's a really strong reason for that. If you're looking to flip a house in a neighborhood, you kind of go in, I mean, you still have to check and make sure, but if you walk into most neighborhoods, everybody's already got electricity, water, gas, if it's on gas, and sewer. They've already got that. It's already taken care of. When you find a piece of land, you don't know if, not only do you not, you have to figure out if it's there. If it's not there, you have to figure out if you can get it there. Because, for
mhm,
example, if it's going to cost you millions just to get water to your property, it could kill your deal.
yeah,
So that's why you see a lot of people who will, as you say, wholesale commercial property, because they're doing the work on the front end to say, here are all the different things you can do, here's what you can't do, and here are the things, wholesaling. A lot of people think wholesaling is simply find it at one price, sell it at another. And in some cases it is. You just add some marketing materials and you're done. Sometimes wholesaling a house could be what we call prehabbing. So we showed earlier a picture of a house that was a hoarder home. Well, it's not that much work to hire a group to come in and clear everything out of the house and then have somebody else come in and clean the entire house. Then you put it on the market. And you can
mhm,
probably make more money just doing that. In this case, wholesaling for a commercial property, it could be doing a lot more work, but adding a lot more value.
yeah. Well, and then, breaking that approach of residential versus commercial on a flip, right? If you're flipping a house, we've seen that take typically 6 months or so, depending on the level of complexity. But if you're flipping like an apartment complex, right? You're buying it as a class C, and then you're trying to upgrade it to a B, right? And then resell it. So you're increasing the value. You're remodeling. It can take longer, but it's still a flip with a bigger investment, bigger return, right? And then you can always have plan Bs, right? If that doesn't execute, then maybe you can keep it, right? Until the market comes back to whatever point you need it to be.
Yeah,
Um,
and I don't want to make people's heads spin or scare anybody, but the picture here, and full disclosure, this is not our property. I kind of wish it was. It's pretty nice. Um, so at one time where this property was a vacant piece of land. And unless it had already been a very similar apartment complex or condo complex, whichever this is, or office, I can't even tell what it is. It's kind of neat. Unless it had been something very similar, 99.9% chance it did not have the power it needed, the electricity it needed, the water, the sewer. It didn't have any of it. It also probably was zoned a certain way, and you had to get permission from different jurisdictions to build something like this. There were probably height restrictions, there were volume restrictions. And then on top of that, again, it's not like doing a house in a neighborhood where it's a house, there's a driveway, there's the road through the neighborhood. They probably had to talk to the Department of Transportation and say, hey, we're increasing the volume right now. No one pulls out of here. Or maybe it's a piece of farmland with one little ranch on it with one driveway. We're going to have 70 people living here. Well, all of a sudden TxDOT's going to say, well, if you're going to do that, you're going to need to expand this road and add entrances. It's this gets into it's kind of a barrier of entry and why most people start out with residential before they eventually, if they do, gravitate towards commercial. It's a little
Yeah.
more challenging, but there's a bigger reward for it.
Yeah, and a lot of the same principles apply to both residential and commercial, which is why a lot of people kind of grow into it. But yeah, even flipping, you can be flipping not only the structure of it, but when you're talking commercial, like multifamily, you can also overhaul like the online presence and the marketing of it, because it is a business that has to continuously find and retain people who are going to continue to pay for that service and that building, right? And then developing, right? That has a much longer lead time. RV parks are pretty quick, but like building a building like this has a much longer lead time than if you were developing in residential. And then of course, managing it, you want to have that expertise, not only in, the people management, the construction management, but also online and marketing management. So passively investing in commercial, right? There's debt and then there's equity. Yes, you could do all of it, right? Like you can buy, like in single family, you can buy the house. But typically for commercial, the price points are so high that not one person can buy it all. So that's why I didn't include it in here. So otherwise, most people would either invest in commercial as a debt position or as an equity position. So I just wanted to quickly highlight the difference between the two. So debt, you can be a private lender, you can be a hard money lender, or even traditional financing. And so sometimes on our deals, we kind of do a combination of them. We can sometimes use like hard money and private to take down the land as we transition to longer term traditional and equity. So same concept you do at residential. If I'm buying it to flip it and then to turn it into a rental, same thing here, where we might buy the land to develop longer term into a business. So equity, real estate investment trusts, funds of funds, syndications, and private investing as well. So Andrew, you want to talk through the differences between debt versus equity as an investor passively?
Yeah, sorry, this is, I hadn't really thought through this one, but simply put, if you're going in from a debt position, you are loaning money to someone. Just like you have a car loan or a mortgage loan or any type of loan you've done, you have terms. The terms include how long are you going to loan it for, how much are you going to loan, what interest rate are you going to charge? And then that's why you need that really strong real estate attorney that'll put in, okay, and here are all the repercussions if that doesn't happen, all the remedies. So that's a debt position. The equity position is more an investment, like putting money into a stock or putting it in the market, where you're saying, I think this is a really good project. It shows really good returns, and I'd like to be in an equity position. There's pros and cons of each. I gotta try not to do just the cons. The pro of the debt position is that you can start getting paid back right away. So for example, if you are lending money to build an apartment complex or an RV park, you lend money and you start getting paid back right away. You can charge points up front, and so you're recouping some of your money, and it's pretty secure. And as we talked about earlier, usually if you're a debt position, a lot of times you're in first position, you are the first person to get taken care of. So that done right, that's the benefit of debt. Rates can vary all over the place. We have had loans, bank loans down in the 5-6% range. And then we've seen hard money loans up into 14%. We've never done that, but there's plenty of people that do. And look, if it helps you if you pay someone 14% interest, but you make 50,000 on the deal, do you care? Maybe not.
Yeah.
So I'm not saying that's a bad thing. Sometimes you have to do that when you're first getting started.
Yeah.
So that's kind of debt. Equity is very different because you're putting the money in, but you don't see that until it starts showing some profit and it's either sold and you make money, or if it's something that's generating revenue, like rents, you share in a percentage of that. In general, an equity position has a much higher rate of return.
Hmm.
However, it also is more risky because you're behind the debt lender. They get paid first,
Hmm.
and you have to wait on your returns, and you're not getting any money back at the start. So that's kind of a high level of the difference between debt and equity.
Yeah. Yeah. Exactly. Beautiful. So pros and cons of commercial.
You giving me the floor here?
Yeah, go ahead.
So even that's negative. You should say you're giving me the ceiling. Um, so commercial, here's the cons. You really got to know what you're doing. And that may sound a little ridiculous to say that, but if you make a mistake on a single family residence, let's say we just had somebody that did that messed up that had a code violation. Yeah, it's a slap on the wrist, and they'll get it fixed, and they'll still do fine. You make a mistake on a large commercial project, they shut your entire project down, and let's say it's a $10 million project, and you're paying on a loan. Um, the pain
Carrying
point could
costs are
be
much bigger.
much
Yeah.
higher.
Yeah.
So you really got to know your stuff with commercial, or be invested in a project with someone who knows their stuff, which
Yeah.
is a really good way to get started. Um, the pros of commercial are, look, Linda and I were doing 1 and 2 rentals at a time. We never had more than a couple in our market. Um, when we decided to do our first RV park, we're like, we get 81 doors right away. That's kind of a cool thing. So there's um, there's some bigger risk and some barriers to entry and some knowledge you've got to have, but the rewards can be much larger, much
Yeah.
larger.
Yeah. No, absolutely. Yeah. So I guess my thoughts are pros and cons is, um, as you were talking about earlier with residential being kind of a lot of competition, not as much competition in commercial, right? I mean, if you're in a specific niche, you're competing against other people, but like, we built our first RV park, we're building our second RV park. Like, we weren't competing against a lot of people on this land, right? And now that we've got
That
it
first
secured,
one, yeah, that first one's a great example. That's on a major road through the Texas Hill Country and at an intersection. And I don't know how many cars go down that highway every day, but it's pretty significant. So
yeah,
people were driving past it. People with real estate backgrounds were driving past it. Um, and everybody was just driving right past it every day. And
yeah,
no one could figure out what to do with it. And that's kind of the charm and the beauty of commercial, that you can kind of take a raw piece of land sometimes and just figure out what could be done, what could it be. So
yeah,
no, it's a great example. If it had been in our market, if it had been a single family house, 200 people would have been calling on it.
yeah. Well, and I think also from an investing standpoint, pros and cons of residential versus commercial is you've got one house, right? That one house could go down, whereas a commercial, it's a business, right? So if you've got like 81 slots, like we were just talking about, and one doesn't get rented, you still have 80, right? So they're different in that regard. But even investing, I would say that in commercial, you've got kind of a little bit more protection. You're not by yourself or only on one issue, right? You typically have, especially the larger the commercial project, you can have professional management companies as a business managing it versus one person trying to keep one tenant, right? That if one goes down, it has a bigger impact versus you assume a level of occupancy on a bigger commercial deal.
Yeah, and you're gonna have to work, because I'm gonna bring up a con right now, so you're gonna have to work hard to bring up a really good pro so that we don't leave on a negative
You
note
guys see what I have to deal with all the time?
all the time. Even, I mean, we could go out to dinner and she has to deal with this. It's horrible. Good thing she has a nice smile. So A good example is when we were developing our first RV park, we started developing it and COVID hit. And when COVID hit, it brought with it, in some cases, we heard inflation in this country was around 6.5%. Well, that might be so on like food products and household goods, but for construction products, a lot of the inflation was 30% and higher if you could even still get the product.
Yeah.
And if you're doing a single house, yeah, that can kill your deal on the single house. If it is, if you're doing an apartment complex and you're going vertical and you need all these materials and everything shoots up by 30% or more, a lot of those projects just completely failed. And now you're not failing on one house, you're failing on an apartment complex. So the risk is much greater, and
Yeah.
got to be very careful with that. And everything's magnified. Again, if you, let's say you got a variable rate loan on a rental house, and we all know what happened in interest rates. A few years ago, it was in the 3% range. Now it's in the 8% range. And if you took a variable rate, which a lot of people did, it was very enticing. So they get down even into the twos. All of a sudden, your rate's going up. And at the same time, as inflation hit, we started having rate compression on what people were able or willing to pay for rents. And a lot of these projects are having issues. So it just gets magnified when you're dealing with commercial.
Yeah. True. Which I think the pro, right?
Oh, good. You came up with one. Let's hear it.
Is you have, like, once you're like us navigating through COVID and through the jurisdictions and inflation, we're really good at like bobbing and weaving through deals. And so, it really pushes you to find more opportunities. And I think that when you're in residential, for example, you can only do so much with a house. But with commercial, you have more options. Like we're adding propane and vending machines and ice machines, finding other ways to monetize. We're even getting creative on our RV park of bringing in people who want to rent their RVs on RV slots. And so I feel like you have more opportunities when you run into challenges, or even if you're good, you can find additional ways to create it. Because the biggest thing is once you have the people there, then you can create additional opportunities to generate revenue where you may not have otherwise. Was that a good call, Pro?
Oh, that was pretty good. You did a good job. I'm impressed.
Yeah, thanks. All right, so if you are an investor and are looking for deals, if you have money to invest now or in the future, and you want to find deals, we routinely have deals, either our own or in our network. And so you can just reach out to us. Our contact info is here. We are sending out a weekly newsletter which recaps this webinar in case you missed it, has a link to the replay. And then on Tuesday, we're hosting another Zoom talking about the deal. And so that'll be at 5 p.m. So if you're on the newsletter, that'll include the link for the registration, or just reach out to us. And then next week, we're so excited because we're going to cover RV parks. We've gotten a lot of interest
fans.
in this, and this is us, right? This is what we do. This was a picture of our first RV park once we were done developing it. So an in-depth discussion around evaluating, developing, and acquiring RV parks. So that'll be fun.
Yeah, again, it's an opportunity for everyone. They may be for you, they may not be for you, but it's a good way to learn about it and decide whether it is or it isn't. And we'll be discussing the pros and cons of it.
I'm sure we'll battle it out.
Oh.
All right. So thank you so much for your time. And reach out to us and join our newsletter so that you can stay in touch. And if you have deals, bring it to us. If you want to invest, bring it to us. If you have questions, let us know. And also let us know what topics you'd like to see in the future.
All right. Thanks, everyone. Appreciate you.
Have a great day. Take care. Bye.